Hi there, and welcome back to Chrome Accounting. I'm Mark Bracken-Wilson. Hopefully you've seen the introductory video explaining my concept of using different colours to help you learn the fundamentals of accounting. In this video, I'll do a bit of a refresher, and then I'll go through each of the 5 accounting elements and the general ledger accounts that lie within each of them. I'll begin by using the continents on Earth as an example. On Earth, we have 7 continents: North America, South America, Europe, Africa, Asia, Antarctica, and Oceania. Within most of those continents, we have dozens of countries. When we talk of Oceania, countries down in the bottom right-hand corner of your screen, we can mention New Zealand, which is where I live. But we can also talk about other similarly located places nearby, such as Australia and Papua New Guinea, which are quite similar in location, time zone, and climate, but still different from each other in many other ways. Every single person on Earth lives on one of these continents, and within a country that lies on one of the continents. In the world of accounting, we have 5 accounting elements. These 5 accounting elements contain every single transaction that a business makes, just like every continent on Earth contains every human being. There are 5 accounting elements. They are owner's equity, liabilities, assets, revenue, and expenses. And we can split these into 2 very important financial statements: the balance sheet and the profit and loss statement. I'll talk more about these statements in a minute. I want to bring your attention to the colours for each accounting element that I've used here. They're very important for my Chrome accounting. The yellow is for the light bulb moment when the owner decided to go into business. So light bulbs are traditionally yellow, and so the yellow equals the owner's equity, that idea, that spark. The red is for liabilities, and this is what the business owes to other people. This is the area of the balance sheet where we find out how much the business owes to external parties. If they owe too much, they're in danger, hence the red for danger. Now, liabilities are a bad thing, quite the opposite. Most businesses borrow money to start up or to expand, which is an amazing thing. However, the business will get into trouble if they borrow more than they can pay back. The orange is for what the business owns or controls. The business has borrowed money from liabilities and owner's equity and has used this money to buy assets to help the business to make money. So the yellow plus red will always equal orange. Owner's equity plus liabilities will always equal assets. On the right-hand side is what the business owes, and on the left-hand side is what the business owns. So the balance sheet tells us how strong the business is. Over to the profit and loss statement. We use the colour green here because green is the colour that we would associate with cash, which is what we've received or are about to receive for the sales that we've made. The blue represents the feeling of paying money out of our bank account, which we don't really like doing, but we have to. This makes us feel a bit sad or a bit blue, as the saying goes. The profit and loss statement tells us how much money we've made. If we take the money that we've received from revenue in green and deduct the amount of money that we've paid out as expenses, we're left with our profit, which is yellow. If you have the colour green and you remove the colour blue, you're left with yellow. Now, because the profit is yellow, who does it belong to? The owner, because the owner had the light bulb moment to start the business in the first place. So that profit belongs to the owner. So that's the 5 accounting elements, the accounting equivalent of the world's 7 continents. Now, all 7 continents have many countries represented in each of them. All 5 accounting elements have many smaller groups of similar type transactions, and we call these general ledger accounts, and they're similar to the individual countries. Let's take a look at some of them for each element, starting with our owner's equity. We have money that's been introduced, or capital that's been introduced into the business by the owner, and that is one separate general ledger account. So every time the owner introduces money into the business, we'll use capital introduced. The owner may also leave some of the profit that the business has made in the business. The business still owes the owner the profit, but they kept it in the business to keep the business running. Sometimes the owner will take money out of the business, and we call that drawings, where they have withdrawn some of the money that they put into the business. These general ledger accounts are all similar in that they're all about the owner of the business, but they're all different types of transactions, so they have their own general ledger account within owner's equity. Let's have a look at liabilities. It's the amount of money that the business owes to someone who's not the owner. Now, the business might buy some stationery and will pay for it next month. We call this accounts payable. We'll also owe some money to the bank for the loan that we took out, and the business may have loaned some money from a relative. These are all similar items, and that's money that's owed to people that are external to the business, but they're different from each other, and so they're all separate general ledger accounts under the liabilities. Let's have a look at some asset accounts. We'll have things like a bank account, a debt from someone who owes us money, like a client who's purchased our boxes but hasn't paid us yet. We might have a vehicle and buildings. Again, they're all different things and therefore different general ledger accounts, but they're all owned or controlled by the business. And now revenue. The main item in revenue element is called sales. This is how much we've made from selling our goods or services. A lot of the time this will be the only item in our revenue element, but there may be other money that the business receives, say from interest on a bank account or renting out spare office space. Finally, we have expenses, and this is what the business must pay in order to sell our products or our service. We've got things like phone bills, power bills, buying the product that we're going to on-sell, like boxes, or wages that we pay to staff. All these transactions are different from each other, but they all belong to the same element, expenses, because they're all regular costs of doing business. So the balance sheet, which tells us how strong the business is, has the elements owner's equity, the profit, and drawings. The liabilities will have accounts payable, the money that we owe to the stationery company, the money that we've loaned from the bank, or the money that we've owned from a relative. So the assets will have cash at bank, some money that's owed to us from one of our clients who hasn't paid us yet. We call that accounts receivable. We'll have a vehicle, and we've got a warehouse. Over in the profit loss statement, we've got revenue from the sales that we've made for selling our product. We've got some expenses here that we've had to pay for the day-to-day running of our business. And that leaves us with our profit, which belongs to the owner. Hey, that's a quick run through of the accounting elements and a refresher on Chrome accounting. In the next video, I'm going to cover a very important accounting concept, the accounting equation. So thanks for watching. Please leave a comment below or a suggestion. Bye for now.